Hi, I'm Sean Osborne, Chief Currency Strategist at Scotiabank. It's been years, decades in fact, since the Federal Reserve intervened in the currency market to affect the value of the US dollar. But in recent weeks, President Trump has repeatedly referred to the euro and the Chinese yuan, implying that the currencies were manipulated or undervalued. This has raised concerns that the US authorities might well intervene in the FX markets to depress the value of the US dollar and provide a bit more lift for a slowing US economy. So just how real is the risk of intervention? On the face of it, probability is low. The last concerted intervention occurred in 2011, when G7 central banks jointly intervened to stem yen strength, following Japan's devastating tsunami in March of that year. Concerted intervention also occurred in late 2000 to support the weak euro. The last time the Fed intervened on its own account in the US dollar was supportive intervention in the mid-1990s. The broad consensus across the G7 since the early 2000s has been that markets should determine exchange rates and that central banks should stay out. So all in all, it's a pretty rare occurrence. President Trump's position on the US dollar has not been entirely consistent since taking office. He noted last August that foreign investors were flocking to the US's cherished US dollar, appearing to equate dollar strength with the performance of the US economy. But also last August, he started to complain that the euro and the Chinese yuan were being manipulated lower, and took Fed Chairman Powell's policy tightening moves, which lifted the US dollar, to task. Nothing much came of the president's remarks last year, but now with the US economy poised to slow, trade deals perhaps proving harder to nail down than the White House had imagined, and global central bank policy tilting back towards accommodation, speculation is rising that the US might break with the convention that has dictated a hands-off approach to exchange rates. We think the risk of Fed intervention remains low, but it has risen somewhat. Experience suggests that intervention can be effective in pushing markets in one direction or another, but success is not guaranteed. One key consideration for the US Treasury is that despite President Trump's concerns, the US dollar is not so misaligned or hugely volatile that remedial action is obviously required. These factors suggest to us that direct intervention from the Fed remains unlikely at this point, as success is not guaranteed. The worst outcome for any central bank is for intervention to be unsuccessful, as it damages overall institutional credibility. We expect the US economy to slow to nearer potential in the second half of this year and into 2020, and anticipate a series of rate cuts from the Fed in the coming months. That should lead to a somewhat weaker US dollar, but whether the US dollar falls far enough to calm the President's concerns remains to be seen. You can find more thought-leading content from Scotiabank on our website, and you can also follow us on Twitter, as well as LinkedIn. I'm Sean Osborne. Thanks for watching.